Hello and welcome to eLagaan Whiteboard Fridays, where we look at various tax and compliance related issues in a user-friendly fashion. Today we will look at something called due diligence, what exactly it is. So we have been hearing a lot that there is a due diligence going on this company or this group. Generally, due diligence is an activity which is taken most of the times in startup scenario and all. If you look at it, is done at a time when investors are trying to put money. So before they actually give you the money, they go through a detailed list of activities, detailed check on all your accounts activities, so as to arrive where you are and you have not been doing something greatly wrong, so that that is not going to adversely affect the business. So that's why they have their own team. They would either hire a legal team or an audit firm to conduct the detailed due diligence. Some of the areas that they cover is actually all the activities is checked in much detail irrespective of what you have done. It's mostly like they will have again a review of each and every activity right from incorporation, and many times it is also pre-incorporation if you have say done a lot of activities pre-incorporation and have brought that to books. So first and foremost is the compliance check. They will look at each and every licenses, business licenses, laws, rules that is applicable to your line of business. And then they would look at whether you have been complying with each of them or not. For example, PAN, TAN, IT return, service tax, PF, ESI, VAT, whatever is applicable. It doesn't mean that you should have each and every license. Rather, whatever is applicable in your line of business, have you taken those licenses right from the day when it was applicable, and have you been promptly filing various returns, paying all the dues to the governments or not, is what they would look at the compliance check. The second thing comes the legal agreements and contracts. So that is any kind of agreement that you have entered right from your employees, within the shareholders, directors, customers, vendors, terms of service, privacy policies, everything. Any agreement or contract that the company has entered into, they would go through each of them and see if we have accepted any risk clauses or if everything is in order or not. For example, if you have to get any business, have you committed too much high to the customer, which could actually impact the prospect of the business in the long run or short run, or can there be a big amount of a liability that could come in? So that's what they would again review in detail, all the legal agreements and contracts. Third would be the check on financials and transactions. So all the data, all the transactions that you have entered into, have they been properly captured, whether there are proper bills or not, whether they have been treated in the right fashion, say an expense has been treated in the right fashion or not. So they would check for all those accuracy and transactions, so as to arrive you have not done something wrong, for which again any liability could come up later at some point of time. See, typically whenever investor invest money, the game is expected to get much more bigger. So the major point of having a due diligence is to make sure if we are not doing anything wrong, which when the company is in a growth mode or is growing high, could come up from somewhere and say, hey guy, I now need to kill the company because something like this has happened. So this is a very crucial activity. Don't look at if anybody is doubting your credentials, but it's also, you also get to know where you are and if you are compliant completely or not. So all your financials, all your tax payments, again returns, not just taxes and all, rather if you have booked the right sort of expenses, anything that should have been allowed or not, have you followed the best global practices, all those things is what they would look at when they check at financials and transactions. Then the cleanliness of the books, like how clean and how regular you have been maintaining it, whether again any dirty transactions, any lot of cash transactions or anything which cannot be justified, all those things, are they captured in the books or not? So that is another thing that they will look at. And finally the promoters, their background as well. For example, do they have please note that all these things, the level of detail and So I can do a very detailed analysis of each and everything. I can go through each and every bill, but then that would also cost a lot of money for the whole exercise and a lot of time. So the level of detail goes or is related also to the amount of funding that you are raising. If you are raising few lakhs rupees or maybe a 50k, 100k kind of thing, then again a lot of things may not go into too much detail. But if it is like multi-million or even hundreds of millions and all, then these things actually become much more important and crucial to look at before they can move further. So one of the things is also promoters key, what are recently with some of the fiasco with say traders and one more company, I'm not remembering. So there the promoters were booked, I think Micromax or somebody. So that has created a lot of concerns among the investors. So they're also now extending it to promoters key, what kind of as a person, are all your transactions clean? Is there any risk factor involved? Because founders are certainly the pillar to success in any of the startups, and if any risk factor can come in from the promoter side, they should be aware of it. So these are more or less the broad areas where they look at it. Now they'll have a like multi-page checklist for this, each and every taxes, anything. We have even seen like going for a lot of theoretical taxes, even if it is practical, it does not allow, but just go ahead and do it, let's do the compliance, all those kind of things coming in from investor lawyers and other stuff. So that's the overall thing on due diligence. Don't get afraid and don't look at due diligence as a negative item. It's actually help you also understand where you are, and good that if something comes up, it is also possible that it can actually be the corrections can be made and suitable steps can be taken. So it's not that if something negative comes out, it's always a loss. Depending on what exactly the problem comes out, there can be a workaround or there can be fixes to it which can be taken again on time, which if again delayed for a long time may cause a lot of issues. So that's it on Whiteboard Friday today. Feel free to drop us an email at support@eLagaan.com or check out our knowledge base at eLagaan.com/KV. Thank you for attending. Thank you.